They say, why does this look different? You are provided with information relating to Vukani Limited, where comments, and listen to this, where comments and explanations are required, you must quote financial indicators, trends with figures, and give a reason. So, once again I say to you, we cannot predict how they're going to market, because it feels to me sometimes the guy who sets up the memo has got a certain word in his mind. And you have like this knife, and sometimes you stab right and sometimes you stab miss. But you will not know. So, don't go into that black hole of what if I can't do it the way they want me to. Breathe, follow your patterns. Right, that's what you do. That's all you can do. So, markup percentage. What's the markup percentage? What is it? What's the formula for it? Gross profit over cost of sales. And let me quickly explain to you. That percentage that I get there is what they really marked up. So, remember, before you do a journal, they say the markup is 50%. That is what they set out to mark up. Ne? That is their official markup. This is their real markup. So now let's say the real markup is 45%. What does that mean? It just means that you had maybe sales and you gave some people discounts. So you didn't constantly have a markup of 50% on every single item. That's what it means. Okay, but now, what happened here? Explain how a change in markup percentage affects customer purchasing behavior and the business sales performance. So what happened here is the business changed their markup. Now, why would a business change their markup? They want to get a bigger gross profit in the end. That's why they do it. So now let's quickly go look. If you look here at the thing here, there. Can you see what they give you there? Your markup increased. So basically it's these things here. Your markup increased. So what happened? Please, they don't want you to say, oh, I think if it increased. They don't want that. They gave you the answers. The customers decreased. There's less customers because the stuff is now more expensive. But can you see the average per customer increased? So even though you have less people buying from you, the people who buy from you are buying more. Weird. And you can also see your total sales increased. So you can mention any of those three. They want how many? 2. So drop in number of customers. 2 marks. Average units per customer increased. 2 marks. Total sales increased. Ne? And then they went further, and I think nobody's going to do that, but maybe there's someone who will go and calculate the average spending per customer. And how would they get that? There is 275 customers, so 3.3 million divided 275. And 3 million divided 300 gives them those figures. Okay? So even though, so what happened now is the markup went up, the amount of customers went down, but the customers who stayed spent more. Go look what you wrote. A lot of you wrote a big philosophy paper there. Next one. Operating efficiency. Now I want you to please remember, when we do operating efficiency, it's the on ratios. So don't go put, what is it that you put in there? Debt equity. Is it on something? No. This is the on ratios. And it's the stuff you find in the income statement. Don't go and put anything else there. So they want to know 2 indicators, that is managing its expenses efficiently. So now let's go look. Where's my on ratios? So my on ratios is there. They gave me 3. Ne? Oh, and nobody can see it now. Yeah. There's my 3 operating ratios. Now be careful. What's the question? The question shows the effectiveness. So we have most learned if it increases it's good, except expenses we want to decrease. Ne? That's most what we did. Now if you go look there, can you see the expenses decrease? So you're definitely going to quote that one. But now look between the other two. The operating profit on sales increased, but the net profit after tax decreased. So you can't quote that one. Okay? So in other words, you're going to quote the expenses and the operating profit. You get what I'm saying? Okay. And easy marks for the ratio and for the figure. Do not accept markup or percentage net profit after sales. Okay. Risk and gearing. What are we talking? Debt equity and ROTCE. Now, let's quickly go to the purpose of each. Debt equity is for the bank to see if it's safe to lend you money. ROTCE is to see is it worth for us to make the loan. So now what are they looking? Comment on the financial risk. Which one of those two ratios do we say high geared, high risk, low geared, low risk? The debt equity. So you need to quote the debt equity. So you go and you look, debt equity is somewhere there. It increased. So what is this company now? High geared, ne? So you say, why did I miss liquidity? Okay, we'll come back to liquidity. Let's finish 2.4. So debt equity increased and we are now high risk. Next one, they ask, explain why investors would use the return on total capital employed when evaluating a company's performance and comment on the limitations. Now this is high order. Okay, now let's quickly look. Why would they look at the ROTCE? Firstly, so this is one of those questions that we cannot anticipate. Right. So this is a new one that you're going to put with your box of knowledge. Okay. So let's quickly go look. I did not understand why they put in that one because we never compare ROTCE with other investments. So I didn't really mark that one, but I did mark those two. So why do we do the ROTCE? We want to see if we are utilizing the loan well. Because now we borrowed money that costs us a lot of money. So we want to compare what it costs us and what it made us. Nee, if it's worth it. So what is the thing? They say here. So remember, you don't have to write high sentences like this, but get the idea. Investors use ROTCE to assess how efficiently the business generates profit from total capital invested. So you just, if you wrote for me, I want to see that you know they got a loan and they used the loan to make a profit. Did they do a good job? That's what we want to see. It indicates the effectiveness of managing and in the using of long-term funds. I personally think they are very much the same, but there we go. Okay, so now let's go. What is the limitation? The limitation is, first of all, it doesn't show your liquidity. So you can now see, oh yeah, the ROTCE is positive geared, that's good. But by looking just at that ratio, you will not be able to identify if the business is liquid. You will not be able to see if it's solvent. Ne? So that's a limitation. What they say here, comparisons may be misleading if companies have different capital structures or operate in different industries. So for instance, what they actually mean is if you go Google, companies like a mining company has a capital outlay that's enormous. So, for instance, if you look at mines, it's got a very big capital outlay before they can even start mining, okay? Because they need those drills and they need to build. You remember when we went to Gold Reef City? Can you imagine how much money it costs to went under the earth and put structures there that's safe? So, in other words, a mine starts off with a very big loan, okay? Because they need to borrow money to get all those machinery. So they start out with a very big capital outlay with a big loan, but it's going to take them a long time before they start showing profit. You see? Now compare that with someone who bakes cake and sells it at school. It's a different set, you see. So when looking at this, you have to take into consideration what type of company this is. Okay? It is based on historical figures and may not reflect future performances. So the fact that we did well this year does not mean that we're going to do well next year with the loan. You see, it's a limitation. We can compare it with last year and see if there's an improvement, but we don't know what's going to happen in the future. Okay. So there we go. They only wanted 1 point here and 1 point there. Let's go back to liquidity. Liquidity, first thing I want to do is I want to see what is my liquidity ratios available to use, and I see there it is. Asset test, debtors collection, creditors payment, stock on hand, not debt equity. Then they say, quote and explain 2 financial indicators that evaluate the effectiveness of a business credit policy. Now remember, credit policy is all about how do I get my debtors to pay and how fast do I pay my creditors. Remember when I explained, I said liquidity goes in 2s. It's the current ratio and asset test goes together to tell me how much stock I have standing still. The debtors and creditors tell me about my policy, my credit policies. The stock on hand, stock turnover, tells me about is my stock taking. Is my stock on hand too much, too little? Is it the turnover well enough? Do I have enough marketing? Is stock turning into money fast enough? So obviously, for this one you're going to quote debtors and creditors, and most of you did that, and I was so glad I almost jumped. I was very happy. So you see, debtors collection, and please, I see this one I didn't fix. Did I fix it on yours? You must please fix this. The creditors payment went from 63 days to 52 days. Just please fix that. Okay. Sjoes nou, hier gaat ons. Let's go on. Next one. Solvency. What is solvency? Solvency is long term. Right? Long term debt. Can I do it? And this one I have to say that the memo was for me weird. But let's see. Comment on the company's solvency position and explain what this change indicates. This change indicates. I think that is the words they wanted you to focus on. About its long-term financial stability. Provide 2 points. So the first point obviously is you're going to quote it. So you're going to say the solvency ratio went from 4.21 to 2.5 to 1. There's 2 points for you. Okay? Let me just get there. Can you see? 2 points. Then, they didn't want you to say anything about you are still able to pay the debt, which is normally would have been right. But what he wanted or she wanted who set this up wanted you to see is that his ability is now not as good as it was. Okay. So it indicates that the company's ability to cover long-term liabilities has weakened. So that is what deproof is, weakened. So we got the word for deproof. Yes.
Ma'am, why would it be wrong if you say that it's better for it to decrease, because you said in class last time that too much asset is not good?
No, that was with liquidity. So with liquidity, not with solvency. With liquidity, please stop talking because I'm trying to think. With liquidity, it's about you want to use your cash efficiently. So if you have too much cash, too much liquid assets, it means they're not really working for you. Ne? Then you would rather take some of it, put it in a fixed deposit and earn an interest. But a fixed deposit is an asset. So can you see that brings up your solvency? So that which I said was not applicable on solvency. It's applicable on liquidity. Solvency, you'd rather have, there's not a thing of you would rather want it less than more. It's with liquidity where you want a balance. Not too much, but enough. Okay. Next one. Dividends. So now, when they say dividends, immediately I know DPS, but also dividend payout. So what are they saying? Returns, I know. Here we talk ROSI. Comment on the dividend payout policy. Explain why this is an irresponsible change in policy. Provide 2 points. So the dividend payout policy, there it is, increased from 69 to 121. So already there you got there 2 points. You see? So the other 2 points, the moment it goes over 100, we are using savings. 2 points. Okay. Next one. Comment on whether the shareholders should be satisfied with the return on their investment. So you're going to quote ROSI. Okay. Include one financial indicator. So what did they do? They said the percentage ROSI improved from this to this, and it's higher than the interest on investment. So this is 1 tick, 2 ticks, and this is 2 ticks. Yes. Oh, did I answer you? Oh, it's because we've been together for so long. 4 years in the making. Let's go on. Next. Share price. So here I learned something Saturday. So remember I said to you, when they say price, you always got, and please make a note of this, because this is something I learned. So it's good that this project happened. So, if I have an issue price or a repurchase price, I want to compare it with the market price and the NAV to see if it's in line. Okay. But if they talk about the performance of the market price, this here is an indicator about the popularity of the share. And this will always be compared to the NAV. Okay. So in other words, if the market price is bigger than the NAV, remember what's the NAV? It's the value the share has inside the company. And if people are willing to pay more for it, it means it's a popular share. Right? If the market price is lower than the NAV, then it can either be that my NAV is over-evaluated. And how do I do that? I retained a lot of income, so then the NAV's price is most going to go up, his value. So I inflate the value. Or it can be that something happened that made my company unpopular. So people don't want to buy the share. Okay. So please write that down somewhere. And if you go look at the memo, which I can't find, here. They wanted both years. They didn't want two separate reasons. They wanted literally, if you read here, they say comment on the share price on the stock exchange for each year. So they wanted 2025 and 2026. Okay. So 2025, if I go look, I literally want to now compare the market price, that, with the NAV. I want to compare those two. And can you see here the market price is lower than the NAV, meaning this is not good. Okay. Here the market price is more than the NAV. That's awesome. Okay. So you're going to mention the figures and you're going to say the one says demand, the other one says, let's see, 26. Yeah, there's a good demand for shares. Then this one, yeah, the shares are undervalued. Meaning my NAV is higher than the market price, so they say it's undervalued on the market. You could also say it's not a popular share, people are not buying it, so the market price is dropping. I would have marked that. Okay. So this is what I wrote down here also. You see, if they say issue price or repurchase price, you compare NAV and market price. If they talk the performance of the market price, you compare to the NAV. Please make a note of that. There's also somewhere in one of the papers where they compare the NAV with the EPS. And I still need to figure that one out. So if you can figure that one out, come to me, that we can share it with the class. Okay. So, last one. Departmental bonuses. Now this one. Oh my goodness, you know what? I was marking and then I stopped and I went to bed. I slept and the next morning I came back because this thing was just so difficult for me to mark. They say performance bonuses are awarded to departmental managers based on how well their departments meet set targets. However, some managers argue that this system may encourage short-term decision making. Comment on the use of performance bonuses for departmental managers and explain how this could affect the performance of the business. Yeah, this was so. While I was marking, I'm saying here. Words that I was looking for is it motivates, it's good, it makes a competition between the different departments, which is good, but on the short term it's not good because they will do a lot of things that might not be good on the long term. Right. So I also said, be careful, this question is not about fairness. It's not about how fair the system is. It's about how does this bonuses affect the efficiency. Okay? A lot of things in life is not fair. You know, you work hard but you don't get the bonus because you did a proper job. They don't care about that. They care about the outcome. Not about if you are rewarded for the fact that you are loyal. They don't care about that. Okay, so if you look at it here, the first one says performance bonuses motivate managers to achieve targets. I didn't mark it reason that they go together. I marked it across the blocks. Okay, because it was too difficult to say, oh, it motivates them, but this and this. It didn't feel like it was logical how the things were fitted for me. So this can improve efficiency, but this can improve efficiency can also go here with the competition. Okay. Competition between the departments. Managers are likely to focus more on achieving results and meeting goals. Can you see that can also go with that one? It may encourage short-term decision making, which on the long term can be negative. Okay. Yeah, but this one was for me a difficult one. I think people who have, who's more into entrepreneurship and people who think like that would have an easy time with this. I think the business kids did better with this than the science kids necessarily. Not necessarily. I don't know. I don't know. I just teach. Let's go on. Question 3. Must I do this a separate video?